Hi, I'm Sally Brady. I am a business planning specialist. Now, I've recorded this webinar today about accountancy jargon because I get asked a lot of questions around what the jargon actually means. And one of the things I preach is simplicity over complexity. So I wanted to run through the three key reports of the accountancy world and what you need in your business and talk you through some of the terminology. Now, some of it is quite difficult to simplify, but actually, if you think about how it's described and what it means, you will actually get the gist of it. So, as I say, I get asked these a lot, so I thought I'd do a quick webinar, 20 minutes of your time, just to explain to you what some of this jargon means. Now, before I start, I want to introduce myself properly. So I'm Sally Brady. I'm a business planning specialist and executive coach. So I've worked in the accountancy sector and corporate world for about 30 years. And obviously I understand about profit margins and people and the pressure it brings. I also have my own company, so I'm aware of the struggles of a business owner and the hats we have to wear. And during my time in the corporate world, I saw a lot of great leaders with very little knowledge of financials. So this webinar is partly due to that as well. So in the corporate world, you have a big, strong team behind you who you don't need to know some of this jargon or terminology because you have somebody to do it for you. But as a small to medium-sized enterprise, small business owner, you don't have that. So my key driver around this is to educate the small business owner, SMEs, to have the vital knowledge to help them grow. And again, this is one of the reasons that I am doing this webinar today, is to help you understand the financial side of your business and what it means. So that's me in a nutshell. So right, I'm going to move on firstly to the profit and loss account. Now, profit and loss account, what is it? Well, it shows the company's income and expenses over a particular period of time. So typically it'll be either a month or a few months at a time or a year. And this information, this statement, it's often called an income and expense statement or a revenue statement, actually shows you what profit or loss that the business has made over a set period of time. So it's historic information. Typically it's usually a month or a couple of months or a year. So we generally as accountants talk about month to date, year to date. So it literally means that a month or a year. Now you also hear it called, as I said, the income statement, because it's giving you and this is where I talk about the terminology, a statement, so a snapshot of your income in time. Another term you'll hear is revenue. Now revenue is income, so it is your sales. And whether those are cash sales, credit card sales, PayPal sales, or credit sales, where you've given them to a customer and you get paid in 30, 60, 90 days. So that is what revenue is. Now, I know some of you will say, well, I knew that. Quite a lot of people don't. And again, this is the terminology that I get asked a lot. The next one I'll talk about is expense. So expense is literally that. Anything you have expensed or bought or been supplied with in your business. So when we talk about expense, you'll see certain lines in the profit and loss account that say something like COGS. Now you're going to say, what's COGS? COGS is cost of goods sold. So it means any cost included in making a sale. So if you have manufacturing, so you have a product, it's the materials, it's actually your factory costs and your direct labour. Now, when I talk about direct labour, I mean the person that operates the machinery to make the product. In the service industry, it's our time. So it's what time it takes to make something. That would be your cost of goods sold. Although as a service-based industry, you don't generally see COGS. It's generally a manufacturing term. So just remember that COGS, cost of goods sold. That's all it means. And I say it's when you break it down in that, it makes more sense. You'll hear about operating expense. Now, again, that's the cost of operating your business. What does it cost to operate your business? So things like that, you're talking about your rent, you're talking about your utility bills, insurance. So anything it costs to operate your business. So what is an operating expense? It's the operation of your business. Again, this is the same for manufacturing or service-based industries. So, what does it cost to operate your business? So how much is your rent every month? How much is your electricity bill? How much is your gas bill? How much is your insurance? How much does it cost to pay your staff, your admin staff, not your direct labour staff, that sort of thing. And the next expense you quite often see is depreciation. Now, again, depreciation is the breakdown of an asset. And by an asset, I mean when you buy a computer. What we do is to even out the cost of buying that product, you actually break it down over, because that computer we do over 2 to 4 years. So you would say, right, I'll take the cost of that computer, it's £1,000, and I will spread that over 2 years, and I'll put that into my account. So that makes it fair. That's fair to your business. So your business doesn't buy something and take it all in one hit. Now, a lot of businesses say anything over £500, they will put into assets and depreciate. So you might have a ruling that's anything over £250, but generally it's a higher value item that you will spread through your accounts over anything between 2 and 10 years, more with land, etc. But depreciation is basically you just feeding that cost into your profit and loss. So you're not taking a big hit in one go. And you'll often hear accountants talking about fair value or, prudency. And it's literally that. It's being fair to your accounts, basically, being fair to your business. So a computer costing £1,000 over 2 years, you would put £41.67 a month into your accounts for depreciation. And that's all it means. It's just breaking the cost down. Now, the other ones you'll hear about a lot is like gross profit. And people often say to me, is gross profit the same as net profit? No, it's not. Gross profit is the profit that a company makes after deducting the costs associated with selling products. So where we talked about COGS, cost of goods sold, you'd find gross profit below COGS. So you would see that the figure is arrived at by calculating and subtracting the cost of goods sold from the revenue. So you would see revenue, COGS, gross profit. So you'd say sales less what it's cost to make the sale equals your gross profit. So it's completely different to net profit. Now, net profit is, and you'll always also hear net profit called EBIT, and our EBIT is on the slide as well. EBIT, earnings before interest and tax. So EBIT is slightly different to net profit in that it doesn't include any interest or tax. So it literally says that earnings before, so anything you've made before interest and tax. Net profit then comes after EBIT. Now, EBIT is something you generally see, it's the last subtotal on the income statement before the net profit and before EBITDA, or EBITDA, some people call it. Now, this is where I think, it can get confusing. So I'm going to take you back. So we've got sales, we've got cost of goods sold, gross profit, and then we go into the expenses, the operating expenses of the business. Then we go into depreciation. Then we get EBIT. And then we will get interest and tax, net profit. Now, EBITDA fits in around this too. So EBITDA is earnings before interest, tax, depreciation and amortization. So that's, again, it comes before net profit because it's the earnings you've made, the money you've made before paying interest or tax or depreciation or amortization. Now, depreciation I explained a minute ago. So depreciation is the breakdown of the costs that you're feeding through into your business over a period of time where it's to do with something like what we call a tangible asset, something that you can physically feel. So it's something like a computer. Whereas amortization is the similar sort of thing, but it's of an intangible asset, so something that you can't physically touch. So it could be something like a patent, or quite often, yeah, a patent is a good one. So it's, it's something that you can't physically put your hands on. So it's something that you know it's there, a trademark, a patent, but you can't actually touch it. So it's the depreciation of the intangible asset. So hopefully that makes sense. So, but if not, I can talk you through all this. I have a monthly subscription that I talk about these things. I talk you through it, because actually showing it on a slide is quite difficult, but I'm hoping to give you an overview of what some of these things mean. Now, I've got fixed cost and direct cost on there. Again, fixed costs, and these all relate to the elements within the profit and loss, within your income and expense statement. So a fixed cost is a cost that basically doesn't change, like your rent. Your rent is right the way through the year, it'll be a set amount. Yes, all right, it might go up or down depending whether your landlord decides to put your rent up or not, but generally it's the same amount. A direct cost is where we come back to COGS. So it's something that's associated directly with the product that you're making. So these are all just terms for you to get your head around. Again, I know this might sound complicated. I think EBIT and EBITDA are the ones that people tend to get a bit hung up on. It's because of them being abbreviated. I would take those out, because in the UK, yes, we use them, but I find that within the businesses I've worked in, they've generally been more European terminology. So I would concentrate on your profit and loss having gross profit and net profit. And they're the basics that you need to know. That's the one thing that, or the two or three things that are actually will mean more to you. EBIT and EBITDA, yes, all right, make yourself aware of them, make yourself aware of depreciation, amortization and things, what the meanings are, but focus on your revenue, your COGS, your gross profit, your operating expenses, and your net profit, and you'll have nailed it. If you get your head around those, you'll have absolutely nailed it. Now, I'm going to move on to the balance sheet, because the balance sheet is something that I find people tend to forget about. So it's something that, I think business owners forget. They tend to concentrate on the profit and loss, because they think that's all they need to know. You just need to know whether you made a profit or loss. But actually, you need to know more than that. You need to know your balance sheet, because your balance sheet is a summary of all that your business owes and all that your business owns. So it shows you how much money you would have left over if you sold everything and paid off your debt. So it shows you your business worth. I think that's the thing that you need to get into your head. It shows you your business worth. So in a balance sheet, you have assets, current liabilities, and long-term liabilities. And they are the standard things, and obviously capital and equity. And all those things brought together are a summary of what your business owns and what your business owes. So if you get your head around that, then again, you've nailed your balance sheet. So assets, you've got two types of assets. Now, I touched on these on the profit and loss. You've got a tangible asset and an intangible asset. So tangible, think about what you can touch and feel, your computer, your machinery, things that you can actually pick up and physically touch. Your intangible assets are things that you can't touch or feel, but they are things that a business would own. So, as I say, like a trademark or a patent. I know when I worked in the cheese industry, there was a certain branding name that was owned and been bought by the business, and that was classed as an intangible asset. So it was a patent or a name that the business actually owned, and it had a value to it. So they had to, what they call, again, I talked about this in the profit and loss, they amortize that. With a tangible asset, you depreciate it. With an intangible asset, you amortize it. They are basically the same thing. They are just different terminology within accountancy. I think accountants made these up just to confuse everybody. So, but keep that in mind. Right. So another asset of the business is the revenue of the business. Now, the revenue would be, you know, when we talk about assets, it's generally the cash flow in and out of your business. So your bank account. So if your bank account's nicely in credit and you're earning lots of money, that'll be a revenue asset. Right. Liabilities. Liabilities, you'll see accruals, creditors, and deferred tax. So an accrual, let's think about this. Accrual is you are saving up for something. So if you were going on holiday, you might save for that holiday. So you put X amount away. You might put £50, £100 away a month. Think about accruals in the same way. They are putting things into the business that you know is going to happen, but it's not happened yet. So you're basically saving up for it. So when it happens, you've got the money there. That is a simple way I can put accruals. Creditors are just the suppliers of the business. It's where you've bought on credit. So creditors, it'll be your supplier ledger, your purchase ledger, whatever you want to call it. It will be the amounts you owe to other people. Deferred tax speaks for itself. It's tax that you are due to pay that you haven't paid yet. And you see deferred tax as a limited company or a PLC and things. You generally see deferred tax that would be corporation tax, basically, that's not being paid yet. So it's been deferred, it's been delayed. So you're not paying it yet, but you are due to pay it. So that's the basics of deferred tax. Next one is current assets. Now you'll see prepayments, debtors, inventory. I haven't put everything on these. These are just the most terms that you see every day on your balance sheet. So your current assets are things like prepayments. Now again, prepayments. Okay, so you have a subscription to a network that you pay in advance. For a whole year, you've paid to belong to that network. But actually, if you were paying monthly, you would take that cost monthly. So what you do is you take the full amount of your network payment, so your £200, and each month you put it in your prepayments account in your balance sheet, and each month you'll say, I'll release £25, £10, whatever it is, the period of time that you've taken that payment for. So you've paid for something in advance, but you don't want to put it into your profit and loss account yet, because actually that's not fair, because you wouldn't normally pay for it in advance. You'd normally pay for it monthly. So you release it monthly. So it's just saying, okay, I've got this pot of money, I've paid out for it, but I actually don't want to put it in my accounts in advance of paying the money. I want it to show it each month, so it makes more sense to me. Now, debtors are amounts of money owing to you. So where your customers generally owe you money. So you've supplied the goods, you've given them credit, you've given them 30, 60, 90 days, whatever it is. I hope it's only 30 days, otherwise you'll be in trouble with me. So you know, this is just the amount that's owed to you. Next one, you've got inventory. Now, if you're a manufacturing business or a business that holds certain products they're selling, you'll have inventory, you'll have stock. Inventory is just stock. And we look at inventory. Some businesses look at it once a year, some businesses look at it every month, some businesses look at it quarterly, biannually or half yearly. But basically, that is the value of your stock at any one time. So inventory is just stock. Some businesses don't have stock at all, so you won't see inventory. So that's the basics of the balance sheet. So again, you know, I can explain this in more detail. Just reach out to me. I'm happy to do that. I appreciate I might have confused you even more. I'm hoping not, because I'm trying to simplify this for you. But your balance sheet, again, it's just think about it's all the money that your business, or everything that your business earns and your business owes. So that's a summary of the balance sheet. Right, so I'm going to move on to the cash flow. Cash flows I'm quite renowned for. I have gained the nickname Sally Brady, the cash flow lady, which It's quite befitting because I always say that your cash flow is king or queen in your business, and it's the thing I'm very passionate about. So if I take you through elements of the cash flow. So a lot of people think cash flow and profit are the same thing. Now they're not, and it's very, very important that you understand this. Because a profit or profit and loss, as we talked about earlier, is the money you have left over after all your expenses have been paid. So that's a statement in time, a historic piece of information that might be a month old that shows you everything that you've got left over once you've paid all your bills. Whereas a cash flow is physical money in and out of your bank account. So it's money that's happening within now. It's here and now. It's, it's something it's an everyday occurrence. And yes, I know you get sales and things in your profit and loss and everyday occurrence, but you don't pay all your expenses out in one go. So the cash flow is monitoring the cash flow in and out of your business. So the cash that comes in, the cash that's paid out. So you'll hear me talk about income. Well, income is any physical cash, any credit card payments that you've taken, any credit you've given to your customer, that's anything that's come in, any backs or direct debit that you get. Some of you use Go Cardless to bring your, for your customers to pay you. So it's when that physical money hits your account. Expenses, they are supplier payments. So anything you pay, you purchase some goods or you purchase a service, that's an expense. Fixed payments are things like your rent, any utility bills, you might have those on a fixed amount that you pay on a budget plan every month. So your electricity, your gas, any credit card payments you make. So you put your credit card amount in, you might pay your credit card off monthly. So you put that amount in your cash flow. So expenses are anything relating to any payment you make out of your bank account. Income is any money you're getting into your bank account. Now, some people say to me, do I put the net amount in or do I put the gross amount in? Well, when you're talking about cash flow, you always put the gross amount in for everything, because as you'll see on the slide, you pay your VAT separately. You pay your pay as you earn. If you're an employee, you pay that separately. So those are the elements. You still put those in, but you put in the gross amount of income, so the total amount of income, before you deduct any tax, and expenses the same. We are always talking gross when we talk cash flow, because as I say, you make the payments to the VAT. So the VAT basically, or any pay is an expense. So you need to show the total amount. So gross equals total amount of income and the total expense. So the gross expense. Now, when I talk about flows and cash flows, I'm talking about projected income. So you might look at income going forward. You'll hear me talk about CapEx. What's CapEx? It's capital expenditure, and that goes back to the balance sheet. So you can see how all these statements are linked. So CapEx is capital expenditure. So it's buying an asset, buying a piece of equipment. But you don't put the depreciation in, because you put the amount the asset cost you, the amount the capital expenditure cost you in your cash flow. Your profit and loss in your balance sheet deal with the accounting side of it. Your cash flow deals with the monetary side of things. And that's why it's important that you, as I say, project your cash going forward, so you can see what happens in your business. So you can physically see in your business here and now what is happening. Whereas your profit and loss and balance sheet will tell you what happened last month or the month before or the year before or the year to date. The cash flow deals with money now as it happens. Now, as I said to you, this is a basic overview, and I hopefully have simplified some of the terms for you. I appreciate you're not accountants, you don't want to be an accountant, some of you will have an accountant, but it's very important that you understand these three key statements within your business to be able to actually help you grow and understand your business and understand what growth you want and what you're asking for when you're looking at information. When you're talking to your accountant, are you talking about your profit and loss, your balance sheet, or your cash flow? Cash flow is something you can do yourself. Now, you can take action with this. You can do nothing and let your accountant do it as normal. Or you can go away and do it yourself and give me a shout and I'll see how I can help you. Or I have a subscription service. Now, a low-cost subscription service. It's pay monthly at £30 a month. I do a bonus one-to-one session, so I spend an hour with you reviewing your accounts, your cash flow, teaching you more about this, going into more detail where you can, we can really hone down on something that you might not understand. And I always say that it's not about judging, it's about giving support. And that's the thing I like to do, is give support. So if you link to my subscription service, and then book 60 minutes with you, and then we can do a monthly review, and we can go through it every month and keep you on track, keep your understanding going. So all you have to do is book a session with me, book the monthly subscription. You get the cash flow management support, you get the financial reporting support, you get the 3 key reports, the KPI and cost savings, and you get also telephone email support. I'm always on hand. Plus you get that bonus of a 60-minute consultation to review your business plans, your cash flow, your accounts, and you also get 25% discount on any additional work required at the end of the day. So just link to my monthly subscription service and we can start building your business and growing your business. So that's it from me. Hopefully I haven't confused you too much. I'm Sally Brady, a business planning specialist, and I'm here to support you.